net issuance towards bills or some kind of good commentary out of the Treasury, QT tapering, and dovish commentary from the Fed. We think as long as two of those three things happen, we could start to see the dollar roll over and perhaps some rally in bonds and broadly better conditions for liquidity sensitive assets like Bitcoin.
It's Tuesday, April 30th, 2024, and this is Markets Daily, a show where we get into the minds of some of the smartest and most experienced investors, traders, analysts, researchers, CEOs, and anyone with a hot or smart take on the crypto markets. I'm Jen Sanasi. Before we get into our discussion today, let's take a look at what's going on in those crypto markets. Bitcoin and Ether are nursing losses this morning after weak demand for Hong Kong ETFs. We've been talking about those all month on this show, and so a little disappointing to see the numbers this morning, but we'll get into that in just a little bit. The 6 ETFs registered first day trading volume of just $11 million as of 8:45 a.m. Eastern Time. Bitcoin was hovering around $61,000 and Ether was down more than 5% at around $3,000. Hong Kong's Bitcoin ETFs accounted for $8.5 million, while the Ether ETFs contributed to the rest. Like I said, a little bit of a disappointment. The market was expecting about $100 million of inflows. Market watchers are keeping their eye on a few different things as we head into May. The dwindling probability of Fed rate cuts, reduced demand for U.S. spot Bitcoin ETFs, and broad-based risk aversion in financial markets as Bitcoin looks to break its 7-month winning streak. All right, let's talk about this. Let's make sense of this. Head of Digital Asset Strategy at Fundstrat, Sean Farrell, joins us now. Sean, welcome to the show.
Hey, Jen. Thanks for having me.
Thanks for being here. Now, like I said, a lot going on in the markets this morning. Probably one of the biggest factors, the disappointing Hong Kong ETFs. What do you make of this news?
Yeah, I mean, it was certainly below anyone's expectations. I don't think there were a lot of, high expectations going into the launched ETFs in Hong Kong. It is a considerably smaller market size in terms of capital and the number of, RIAs that are able to invest in these products. And, they've made it pretty clear, these issuers, that capital from mainland China is not yet able to access these ETFs, which makes sense given that crypto is banned in mainland China. But, I think people were pretty put off by the single-digit million numbers of inflows that we saw last night.
It's so interesting you say that because we had guests on this show throughout the month of April who were very excited about the Hong Kong ETFs, and there was some discrepancy whether it would be available to mainland Chinese investors. It seems that that's not the case. If it does become available to mainland Chinese investors, like other ETF products that are available in Hong Kong, do you think that we'll see more demand?
I think so. We've seen, Shanghai gold premium spike over the past several quarters. And this is largely due to a lot of the turbulence within the mainland Chinese economy. A lot of individuals, particularly wealthy ones, have been looking for outlets to park their capital, not in Chinese equities or any Chinese assets for that matter. And gold has been a great outlet. I think part of the spike in copper prices, in addition to, increasing PMIs and general solid growth, globally, I think a lot of Chinese investors have actually turned to copper and other commodities for parking their capital. So that is all to say that, eventually, if there is a way to move capital into Bitcoin, into these ETFs, it certainly will be a solid tailwind, but I'm not sure that's going to happen in the immediate term.
Well, what are you looking forward to? Because we had the ETFs in the United States, we had the halving, now we have the Hong Kong ETFs. It seems like there are some mixed signals in the markets. What are you looking to as the next catalyst?
Yeah, so I mean, look, the ETFs are this sink and this outlet that opens up. It widens the aperture of possible investors in this asset class. So whenever the market ebbs and flows, those movements just get a little more magnified. But ultimately, at the end of the day, we are still at the whims of the underlying macro backdrop. And I think right now we've had this perfect storm of uncertainty, which has caused this buyer's strike, so to speak, over the past couple of weeks. We've had bonds really sell off over the past X number of weeks. The dollar has rallied pretty hard, frankly, year to date. We've had a repricing of SOFR futures since we've priced out at the start of the year. We had, I think, 7 or 8 cuts. Now we priced in one by the end of this year. In addition to that, I think a lot of people are focused on this upcoming quarterly refunding announcement from the Treasury. Given the size of the projected fiscal deficit and let's say some of the waning interest in purchasing long dated bonds at these levels, I think a lot of investors are a little cautious heading into this QRA to see how the Treasury looks to fund itself over the next couple of quarters.
Well, let's talk about that. The quarterly refunding statement is happening the announcement's happening on Wednesday. What are you looking to see here, and how could it impact crypto assets?
Yeah, so when you're looking at what the Treasury comes out with, and just for some additional context, the QRA is the acronym for the quarterly refunding announcement. There's 2 parts to it. One, the Treasury comes out and announces its total buying needs for the rest of this quarter and the next. And then 2 days later, which this quarter will serendipitously fall on the same day as the FOMC meeting, that's when the Treasury puts out the composition of their issuance over the next couple of quarters. And high level, what is better for risk assets ultimately is that if the Treasury decides to fund itself towards the short end of the curve, because that is generally speaking, more liquidity neutral for the market and for banking reserves, because there is still capital locked up in what is called the RRP, which is a lot of money market fund capital that is looking to, only invest in extremely short dated things. So either, the Fed overnight rate or, 1 month T-bills. And so you have this exchange of liquidity between the RRP and these T-bills, which, the RRP is not currently in the private banking sector. And so you're not necessarily pulling capital out of that in the same way that if the Treasury issues coupons, you have this exchange of banking reserves for these long dated bonds that are issued by the Treasury. And so that's net negative liquidity conditions from a very high level. And so one thing we'd like to see is a greater skew towards shorter dated bills to fund things in the near term. But, I think in addition to that, it's important to see what kind of commentary the Treasury puts out. They've talked about instituting buybacks to ensure liquidity within the Treasury market remains robust. I think something like that could really help to assuage fears about a major bond sell-off or major risk-off event. In addition to that, I think there's a very good probability that the Fed, again, you need to look at these two, the QRA and the FOMC, you have to look at them in tandem. We think there's a pretty good probability that the Fed comes out, and due to, as I mentioned before, the fact that this RRP, which is to the Fed, it's kind of this barometer for excess reserves in the banking system. The fact that that is being drawn down upon, they don't want to see that go towards zero or, cause some kind of lockup in the short-term interest rate market. And so, our base case is the Fed comes out and actually announces a tapering of QT. And so I think if we have something, and in addition to that, one last thing, despite the hot CPI prints over the past few months, it's still our view that the Fed will maintain its stance that the next move, timing aside, will be a cut. Now, it might take a little while, but as long as they maintain that stance, that is still net dovish in our view. And so as long as 2 of the 3 things happen, net issuance towards bills or some kind of good commentary out of the Treasury, QT tapering, and dovish commentary from the Fed, we think as long as 2 of those 3 things happen, we could start to see the dollar roll over and perhaps some rally in bonds and broadly better conditions for liquidity sensitive assets like Bitcoin.
You have this buy in May and go away mantra. Explain that a little bit for me.
Yeah, well, it ties into exactly the thesis that I just outlined, which The QRA details that composition element of the QRA, as well as the FOMC meeting. That's going to happen tomorrow with the 1st of May. And so, of course, our base case is that will go well for the rates market and for broader market liquidity. And, there's an old saying in markets that volume tends to dry up May through, September, and people really only trade October through April. And so like the saying is sell in May and go away because nothing really interesting happens. So we kind of flip that on its head and say buy in May and go away. The go away part might be a bit hyperbole, but that's our base case right now. Of course, we'd like to see, what we'd be looking for is after May 1st, we'd like to see the first couple of days of trading, the dollar start to roll over, bonds start to get bid, and that would give us more confidence in this thesis around this pivot point. But of course, we're always cognizant of the fact that things might not go that way, and we'll adjust accordingly.
Sean, Tom Lee, who leads your firm, said that Bitcoin could be heading to $150,000. Now, that was at the beginning of the year. A lot has changed since then. Some analysts are even saying that we are no longer in a bull market. But what's your price prediction for the end of the year? Do you think that $150,000 is still possible?
Yeah, 100% I think is possible. We put out a price target of 125K in January. That's our crypto team. Tom and I, we directionally agree. It's just more of a timing and details thing. I think if Bitcoin landed somewhere between 125 and 150, neither of us, would be disappointed in that. But I think structurally, longer term, we are still bullish over the next 12 18 months. We still have the medium to longer term tailwinds of QT eventually coming to an end. We have fiscal deficits, which are both stimulus to the economy and to financial assets, and will eventually require some kind of engineering at the long end to maintain real rates kind of where they are. And then, we also have central banks around the world starting to ease. We've seen easing out of the, obviously out of the BOJ and the PBOC. And then we have, industry specific tailwinds like the ETF, which I mentioned is not necessarily a catalyst, so to speak, but it's, it widens the profile of investor that can touch this asset class and increases the potential flows. And obviously we just had the halving, which, is not, in our view, like a tradable event, but certainly as more people learn about it and get educated on the Bitcoin's monetary policy, that can spark some additional demand, and obviously it helps on the supply side of things. And so, there's still more things working in Bitcoin and in the wider crypto market's favor at this point of the longer term. A lot of the risks that we're discussing right now are more of a 2 to 3 month type time frame situation.
All right, we've talked macro, we've talked a little bit about the ETFs and Bitcoin, but I want to talk about meme coins because I know that you're watching them and I want to know what's giving them staying power in this market. How do you expect to see meme coins perform over the rest of the year?
Yeah, so I mean, the way that I think meme coins are a hot topic, right? Because they rub a lot of different people the wrong way. You see a lot of crypto native individuals who perhaps take themselves too seriously.
The memes are supposed to be fun. You can't.
Right. And look, for good reason, there are serious things being built in this industry, and we want to highlight those. We don't want to see the only articles that Bloomberg runs to be on dog with hat. But, I guess from a portfolio construction perspective, I look at these as out of the money call options on speculative capital coming back into the fold. And I think, traders have just kind of gotten, we've had a pretty good sample size at this point of every cycle there being a meme coin run towards the end. And frankly, I think what just happened is that we had these exogenous flows from the ETF that kind of pulled a lot of that risk taking forward. And the fact that we've already had this proof of concept, it's possible that this type of, barbell strategy where you're very concentrated in the majors, be it Bitcoin, ETH, Solana, and then try to really juice your returns with a small part of your portfolio in meme coins that may persist, and we think it likely will. Outside of that, I think there's a big there actually is a fundamental takeaway from this meme coin cycle, because you had a lot of them launched, a lot of them easily traded on Solana, and while again a lot of them are silly and not based on anything fundamental, it does show how easy capital formation and the trading and exchange of digital assets on these platforms, specifically Solana is. And so if you really think about it, it is there actually is a fundamental takeaway. But from a portfolio construction perspective, we think the good way to look at it is just kind of a call option on frivolous speculation.
All right, Sean, and if you're looking at portfolio allocation this morning, what are you doing?
Yeah, so I mean, a few weeks ago we put out allocation strategies in our research to guide both institutional and retail investors in kind of navigating the market. And we also offer opinions on crypto-linked equities. And we raised a little cash by selling some alts in that sample portfolio a few weeks ago, due to some of the headwinds that we just discussed. I think right now it's probably smart to be concentrated in the majors, specifically Bitcoin. We've seen a lot of the alts, specifically ones that have come to market with these high fully diluted values and low float, really get wiped out on any kind of drag, any kind of sell off. And I think it's probably a good thing. It means the market is getting more efficient, and people are kind of understanding supply dynamics a little better. And so I think moving forward is just going to be smart to be more selective with alts, right? And so I just to come back to your question, I think right now in the immediate term, be pretty heavily weighted toward the majors, specifically Bitcoin, have some cash on hand, and then reassess post May 1st.
Sean, it's always a pleasure having you on. Thanks for joining Markets Daily.
Yeah, thanks for having me, John.